Hello and welcome to this video about master budgets. This is our chapter overview video for chapter 7. So in this chapter, when you're done, you should be able to describe budgeting objectives, benefits, and procedures, and how human behavior influences budgeting. Define budget types and the components of the master budget. Prepare components of an operating budget for a manufacturing company and prepare a cash budget. So a budget is a financial plan used by managers to coordinate business activities with goals and strategies. Imagine you and your partner are planning a trip or planning a wedding or planning to buy a house or anything else. You need to coordinate how you're going to save the money in order to do what you need to do, right? And it's kind of the same idea in businesses. Managers in different divisions and different areas need to coordinate in order to achieve the goals and strategies of the company. Now, human behavior comes into play a lot in budgeting, and we can talk about that for a long time, but of course our time is limited. So let's just mention the fact that budgets need support. And generally the way managers make sure that they get support from their subordinates is by asking for input. So by asking people to provide their input to a budget, they are more likely to support it because it came from their ideas. Now the master budget looks like all of these pieces. So there are a lot of budgets here, right? The entire process begins with the sales budget. The sales budget is the most important budget because everything else depends on it. Imagine that you own, say, a restaurant, and your restaurant, you have no idea how many clients, how many customers are going to come to your restaurant. Well, how do you know how much food to buy, how many people to hire, etc., right? So that's why the sales budget is very, very important because it drives everything else. So from the sales budget, a manufacturer will know how much they need to produce, and that will determine how much they need in direct materials, labor, and overhead. And those lead to our cost of goods sold and selling and administrative expense budget. Now, we don't look at the capital expenditures budget in this chapter. That is a separate chapter that we look at later on in the semester. But we are going to take a look at the cash budget, which is extremely important because imagine that you don't have enough cash. Well, that's a big problem, right? So the cash budget helps plan cash coming in and cash going out and make sure that the company has enough cash on hand. And the information from that helps with the budgeted income statement and balance sheet. Now, in this video, we're going to talk about the sales budget, the production budget. We're going to take a little peek at the direct materials budget, and then we're going to look at the cash budget because we have limited time. And those budgets, once you know those, you should have enough information in order to prepare the others. So here's a sales budget. This is from your text. The sales budget shows how many units of product the company plans on selling each quarter. And then that is multiplied by the selling price per unit, which in this case is $500. These are tablets. And that gives us our total sales. Your total for the year is either going to be this total across times the 500, or you can add these four numbers across and get the 1,150,000. Either way, it should be the same. So now take a look at these numbers because we're going to look at them in a minute again. 500, 550, 600, 650. All right, easy numbers to remember. So remember, the sales budget drives everything else. So now the production budget comes after the sales budget. So now we know how many units we're going to sell. We need to figure out how many we're going to produce. So here are those numbers I just mentioned, 500, 550, 600, 650. The sales budget is the selling units to be sold is the first line of the production budget. Now, you can't just produce enough units to sell for that quarter because, first of all, you're going to have some inventory on hand at the beginning, and then you need some inventory at the end because the quarter doesn't just end. Customers don't stop buying just because it's the end of the quarter. The next day, they're going to need more units. So in this particular case, the guidelines are that ending inventory should be equal to 20% of the next quarter's sales. All right. And beginning inventory for the first quarter sometimes is given to you. You'll be given the number, or it may follow the pattern. So if you're not given a number and you're confused, it could be that you just need to follow the pattern. In this case, we're not following the pattern because the pattern would have been 20% of 500, which is 100, but our beginning inventory is actually 200. Now, remember that one period's beginning inventory is the next period's, one period's ending inventory is the next period's beginning inventory, and that works for all of those. Now, let's see where these numbers come from. Remember, we said this comes from the sales budget. Then we're going to add in the 20% of the following quarter's sales. So 20% of the 550 gives us the 110, and here and here. So we take 20% of the next quarter's sales, and that gives us our desired ending inventory. Now in the fourth quarter, you're going to have to go to the first quarter of the next year in order to get this number. All right, it's not showing on the screen here, but of course, 20% of the next quarter is going to be the number that goes here. Now you add these two together, and that's in the first quarter, that will give us 610. Subtract your beginning inventory, and that will give us our tablets to be produced, or our units to be produced for that quarter. All right. There is a production budget video if you want some more guidelines on that, but I think this probably will give you the information you need to finish up. The total is the thing that often gives students problems. Remember that the total looks at the year as a whole. It's not one quarter, it's the year as a whole. So the beginning inventory here is the beginning inventory for the whole year. When did the year begin? Well, the year began in the first quarter, right? And the ending inventory is the ending inventory for the whole year. When is the year end? In the fourth quarter. All right. So pay particular attention to that quarter because sometimes that gets a little tricky. These will add across when you're done. So that's one way to check, right? These four numbers are going to add across. So the company plans on making 410, 560, 610, 660 in the 4 quarters of the year. Now the production budget, remember, drives materials, labor, and overhead. Let's take a quick look at the direct materials budget. So here's the 410, 560, 610, 660. Those come right from our production budget. Now the direct materials budget, don't get confused with the units. There are 2 different kinds of units on here, right? We have the budgeted tablets to be produced. That's the finished product. And then we say, well, it needs 3 pounds of product per tablet. So to make 410 units, you need 1,230 pounds. Once you do that, this part looks very much like the production budget. You add your desired ending inventory, subtract your beginning inventory, then you get your purchases of direct materials. This is pounds, remember? Multiply that by your cost per pound, and that gives you the total dollars that you are going to spend on direct materials. And this goes on later because this is going to affect our cash budget, right? Because these are things we need to purchase, the direct materials, and that's going to be cash. Okay. Again, notice the inventory amounts. They're not totaled. Those come from the beginning and the ending of the year. All right. Now, the cash budget is pretty complicated. The cash budget is supported by 2 schedules. One is the schedule of cash receipts, the money coming in, and the other is the schedule of cash payments, the money going out. So cash receipts, that's the money that our customers are paying us. Now, let's take a look at this. We have our sales from the sales budget. Now, these are sales in dollars because remember, cash we're interested in are dollars. Okay? So our sales in dollars. Now, this is what we know. 30% of the sales are going to be cash sales. And then of the other 70% of the rest, 60% are collected in the quarter of the sale and 40% in the quarter following the sale. We're not worrying about bad debts here. Now, look at this a couple of times because I've taught this many times in class, and I can tell you that once you get it, you get it. But sometimes it takes a little bit to get it. So don't panic if you don't get it right away. Go back, look at it again, work through the numbers yourself, and that's going to help you. Okay? All right, so let's look at the first quarter here. In the first quarter, these are the numbers that we're going to be collecting. First of all, we're collecting the receivables from last quarter, right? At the end of December, customers owed us some money. They owed us 40% of the fourth quarter. Now, in this quarter, we're going to get paid. Remember, cash sales are 30%. So we're going to get paid this quarter's sales, $250,000 times 30%. That's our cash sales. Then, of our credit sales, $250,000 times 70% are our credit sales. Of those, we're going to collect 60%. So the $105,000 is the sales times the 70%, which are credit sales, times 60% getting collected in this quarter. Now the rest are going to be collected in the next quarter. All right. Notice that if you add up these three green numbers, you're going to get your first quarter's sales, right? They're all collected between the first and the second quarter. All right, so now the part that's collected in the next quarter is the $250,000 times 70% times the 40% that's collected in the quarter after the quarter of sale. Then we're going to continue the pattern. We're going to take 30% of this quarter's sales, so $275,000 times 30%. We're going to, of the 70% that's left, we're going to take 60% is going to be collected in this quarter, and then the other 40% is going to be collected in the next quarter. At the end of the year, I want to mention something important, and then at the end of the year, notice that there are 3 items in every column. I tell my students these are like steps. Every step has 3 boxes in it, right? Because we have cash sales, we have credit sales, and credit sales every quarter, right? Every quarter we have cash sales from this quarter, credit sales from last quarter, and credit sales from this quarter. So make sure when you're doing your budget, they're not all necessarily going to be 3. They might be 2 or they might be 4, but make sure that they're all even, right? When you're done, every step should have the same number of items in it. Now at the end of the year, remember here we had this 30%, we had the 60% of the credit sales, but the 40% will be collected in the following quarter of the next year, and that becomes our accounts receivable at the end of the year. Okay, so remember that goes to our balance sheet. Remember, accounts receivable is a current asset, and that will go to the budgeted balance sheet, which we're not going to look at. Okay, now let's take a look at the schedule of cash payments. We're going to take a look at this piece in a minute, but let's just look here. We have our direct labor, which comes from our direct labor budget. We have manufacturing overhead, which comes from the manufacturing overhead budget, and we have selling and administrative expense from that budget. These budgets are fairly straightforward. As long as you understand variable and fixed costs, you'll be fine with those. They're very straightforward. The income taxes will be given to us, and remember, capital expenditures also will be given to us because those are from a separate budget that we're not working on right now. And then we're going to see the accounts payable at the end of the year is similar to the accounts receivable. Now let's look at, I forgot to mention, don't forget, this is very important, depreciation expense is a non-cash expense. Depreciation expense does not use cash, right? Depreciation expense is an allocation of the cost from an asset that you bought previously. So do not put depreciation expense ever. If you see that in a problem and you're doing a cash budget, remember depreciation expense doesn't go there. It would go on your budgeted income statement, but it will not go on your cash budget. All right. Now let's take a look at these cash payments. Notice here, these steps are 2s, right? These are 2 steps in each quarter. Because all of the purchases are on account, they pay for 75% of them in the quarter of purchase, and then they pay 25% in the following quarter. These total direct materials purchases come right from our direct materials purchases budget that we did before. And then we're going to follow the pattern. All right, I'll let you work through this, but you're going to take this quarter times 75%, and then you're going to take for the next period, this quarter, the previous quarter, right, times the 25. And you're going to follow that pattern. So here we have 87,000 times 75%, and then you're going to keep going all the way down to the end. In the end, your accounts payable here is going to be 25% of your fourth quarter, because you're paying for 75% of it now, and then the other 25% will be in the following quarter. Now, here is our cash budget. We're not going to do everything on here, but let's just take a quick look. The most important thing of cash budget, think about your own cash. How does a cash budget work? Well, it's your beginning cash balance. It's however much money you had, plus your receipts, how much money's coming in, and that gives you cash available. Minus, whoops, sorry about that, minus how much money you paid out, your cash payments, and that's going to give you how much money you have. That's cash balance before financing. Now, most companies have what's called a minimum cash balance, and that means they need to have a certain amount of cash on hand so that they have the money they need to pay whatever bills come in. So in this company, the minimum cash balance is $30,000. So at the end of the first quarter, they only have $24,285. They borrow in $1,000 increments. So that means in order to get the $30,000, they have a shortage of $57.15. They have to borrow $6,000. They borrow the $6,000, and this $30,285 is equal to the $24,285 plus the $6,000 borrowing. Your ending balance from one quarter is your beginning balance for the next quarter, right? Remember, these cash receipts came from your cash receipts budget. Your materials payments came from the schedule of cash payments that we looked at before. And then, then all of your other items come from your other budgets, as we mentioned before. Let me just mention quickly the interest. So in the first quarter, we said that we borrowed $6,000. They tell us that we pay interest at 3%. So in the next quarter, 3% of $6,000 is $180. And that interest goes here because we borrowed that money. Now, when you get to the end of the second quarter, there's only $190, so we don't have enough money to repay. So that means in the next quarter, we also have to pay $180 because we still have $6,000 that we've borrowed. At the end of the third quarter, they do have enough money to pay back because they have an excess of $89.95 after their $30,000 minimum cash payment. So they pay back their $6,000, and now we have $38,995 minus the $6,000. That gives us the $32,995 ending. That gives us the $32,995 beginning in the fourth quarter. And we don't have to borrow in the fourth quarter because we have plenty of extra. So particularly for seasonal companies, this is very, very important because maybe their lull is, around here, and this is where they have to borrow some money to get ready to go into the third quarter and the fourth quarter. All right, so that's all I have for now. I think you should now be ready to work on your chapter materials. See you in the next video.